Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, your host today, Thursday, February 25th. After a few slips and slides throughout the month that got the equity bears salivating, stocks continue their march higher, with the S&P 500 up almost 5% and the NASDAQ up 2.5% on the month. The bigger story out there is reflation, inflation, and a rotation. With the COVID-19 vaccines rolling out across the globe, expectations of easing lockdown restrictions and a more normalized economy are being priced into markets. The world has embarked on the biggest vaccination campaign in history. More than 213 million doses have been administered across 95 countries. In the U.S., more Americans have now received at least one dose of the vaccine than have tested positive for the virus since the pandemic began. Combine the expectation of a more normal economy with continued accommodative monetary policy and extremely aggressive fiscal policy, and you've got a recipe for potential inflation. While inflation break-even rates had already started to rise last year, Treasury yields and commodities, while rising in the latter half of the year, had yet to really take off from their pre-COVID levels. 2021 is turning out to be a very different animal, with Treasury yields breaking out higher and commodity prices on the move. The 10-year Treasury yield is up over 100 basis points from its intraday low last year, and the Bloomberg Commodity Index now sits up over 7% above the pre-COVID 2020 highs, up over 47% from the pandemic lows last March. With rates on the move and normalization on the horizon, the rotation out of high-flying mega-cap growth and tech into value-oriented and small-cap equities is finally happening. The Russell 2000, which is comprised of small-cap companies, is up over 14% year-to-date. The Russell 1000 value is up almost 8% versus the Russell 1000 growth up approximately 1%. With the yield curve steepening and net interest margins improving for the banks, the KBW Bank Index is up a whopping 22% year-to-date. Active equity management is back. Since the start of the year, 57% of large-cap mutual funds have beaten their benchmarks, making the industry's best start to a year in almost a decade. We're now a year into the pandemic. The pandemic has changed the way consumers and businesses behave. Understanding and predicting those changes is the key to successful investing in today's market. The real estate market is probably one of the sectors that has seen the most change in how it's utilized by consumers and businesses. Homes are now offices, offices now sit empty, and online shopping has all but taken over the retail environment. We've got a special guest today to discuss these ever-changing real estate markets with me, Larry Mendelsohn, president of Flanders Street Capital Management and partner at Aspen Capital. He's the CEO of both the mortgage REIT and a commercial property REIT, focusing on multifamily real estate. He's also a former professor at my alma mater, the University of Southern California. We're excited to have him join us today. Welcome to the show, Larry. Larry, thanks for joining us. We're excited to have you here. It's been a year since the start of the pandemic, or almost a year, depending on what state you were in and when lockdown started. So we thought it was a good time to maybe talk about some of the harder hit parts of the economy, real estate being one of them, given that businesses and consumers are just utilizing real estate so differently, right? Your house is now your office is largely empty, and retail stores have been in full force, seemingly taken over by the Amazon effect and things like that. So really excited to have you here. Why don't, for the audience, you've been in the business for a really long time, maybe tell us about your background and how you got to where you are today.
Sure. Grew up in Buffalo, New York, and went to college at University of Chicago. I got a summer job at JP Morgan by accident while I was at University of Chicago. And that got me involved in the financial services side from what I was studying at Chicago. Went to grad school and then taught in the business school at USC, undergraduate, juniors, seniors, and first-year MBAs. I taught corporate finance and investment theory. And then in late 87, my boss from the summer that I worked at JP Morgan when I was an undergrad gave me a call and said, I'm starting a group. I want to know if you want to come start it for me. And I said, sure. And I picked up and left Manhattan Beach, California, and moved to New York. And then spent 5 years there running an algorithmic trading group and a derivatives group, kind of credit default swaps, things like that. And then moved over to emerging markets, which back in the early 90s was really just distressed debt. In 94, 3 of my longtime clients at JP Morgan said if I wanted to start something, they would back me. And here I am 26 years later, and 2 of those 3 are still 2 of my biggest investors, and a long-standing relationship. So I kind of got into the industry accidentally, but have enjoyed it and have liked as an industry where you can kind of be value-oriented, but also be entrepreneurial at the same time. And it's been a great experience for me, and building companies and investing.
Yeah, you've had a lot of interesting things you guys invest in. So there's we'll touch on some of that.
Sure.
You know, before we dig into real estate, you know, crazy markets these days, stocks near, you know, at or near all-time highs, deficits that we've never seen, you know, quantitative easing till infinity from many large central banks. How are you thinking about the capital markets, the liquid markets, at least right now?
We're a little surprised how, particularly in some of the structured credit markets, where people seem to be a little less concerned about credit risk, and certainly on the asset side, they seem to be more focused on where they can finance things than as opposed to where the underlying assets could go, or what the underlying risk for the credit around it is. There seems to be an enormous amount of capital that needs to be put to work. We get phone calls pretty close to every day asking if we can find assets for people. While I really like getting those phone calls because it's psychologically an endorsement of their belief that we're able to, find good value, it also makes me nervous that I get calls from people I've never met asking if I can find them assets and run it for them. So that makes me a little bit nervous that there's a little bit of froth in the pure kind of credit side of at least the kind of assets that we look at.
Yeah, absolutely. And you have spreads of largely full round tripped in many parts of the market, like high yield bonds, for example. I mean, at one point we joke here that can you really call it high yield when it's sub 4 yield? It's just yield.
No,
now.
That's exactly.
It's not really high.
Yeah, we have kind of a fundamental idea that risk needs to be priced on 2 ways. One is a relative basis that, yes, some things are riskier than others and they should trade on a relative basis for something. But on the flip side, we also think that for certain risks that you take, there's an absolute minimum level rate of return you need to receive, so that if the probability of default times that kind of what losses you would have versus the yield, it still has to be an okay outcome. It doesn't have to be the outcome that you expected in terms of total return, but we understand how if you're right, you can make 4%, and if you're wrong, you're willing to make 2.5%. But we don't understand if you're right, you make 4%, and if you're wrong, you lose 60%.
Yep, absolutely. That's how we think too. It's all about kind of the convexity of returns. And people look at convexity for things like mortgages, agency mortgages, but you can apply that same concept to credit. What's my upside? What's my downside?
That's exactly right.
And up 4, down 60 doesn't sound so good.
That's exactly right. It doesn't. And we like to invest in ways that we can come up with an expected band in return. So if I'm wrong, this is what I make. And if I'm right, this is what I make. And if I'm in between, I'm somewhere in between. So I know kind of from a predictive or forecast modeling, I know within a range of where we should be over time, as opposed to let's go all in and hope for the best, which I think there's more of that than there was a few years ago.
Yeah, people are forced right now to take risks. So
Yes.
the capital is just finding anywhere it can go where it thinks it can generate returns, unfortunately. One of the markets that
right.
during the global financial crisis, we saw that extreme downside was residential non-government guaranteed mortgages, and how big decline in housing. I've talked a lot and I've written some white papers here about how the housing market is different this time, not the same setup as the global financial crisis, but I'm sure people are tired of hearing about it from me. What about your take on it? You're a pretty big investor in mortgages and riskier mortgages, in fact, on the reperforming loan side. But what's your take on the housing market here?
Sure. We would 100% agree with you that this is very different than the 2008 time. The 2008 time was more about the banks and the system as opposed to the asset, for example. Here, we're definitely seeing a separation between residential and commercial. We've definitely seen in residential that also is very local market functionally. We've definitely seen a lack of inventory, and I think people don't realize that the lack of inventory has been an issue for probably since about 2010 or 2011, not just a recent lack of inventory. That if you look at kind of supply back pre-2009, there were 2 million homes being built a year, and that number by 2010 was down sub 1 million. Yep. And replacement, and you need about 1.3 million, 1.4 million a year to really of new supply to offset demolition and just population growth and family growth. And then that's kind of become more extreme in certain markets. Then when you combine that with low mortgage rates, the idea that you want more space, and a pandemic where people aren't selling their homes, they're staying in their homes, which further decreases supply, further decreases inventory. It's a very ripe time for home price appreciation. And I think a lot of people don't think about the math behind a simple reduction in mortgage rates. So if you have a $400,000 house with a 4% mortgage, your payment is $16,000 a year of interest. If you go to a 3% mortgage, you can have a $500,000 house and your payments in interest is still lower. It's $15,000. So just from mortgage rates going from 4 to 3, your house gained close to $100,000 in value. And so a rise in mortgage rates will slow down kind of the housing frenzy. But until the inventory issue and more supply of new housing is created, there's still kind of a structural deficit of numbers of houses. That's less true in certain markets. That's less true in certain markets. In the Midwest, that's not as true, for example, in Chicago as it is in Florida or as it is in Phoenix or places like that. But it's still a structural issue.
Yeah, the low inventory was one of the things that we were looking at. That was going to be massively supportive for housing. I guess one of the things that I questioned was the bid for vacation homes when the pandemic first started. I mean, I thought VRBO, they're screwed. I mean, who's going to want to go into somebody else's house? And then as we found out that the virus wasn't transmitted so much from touching items, it's more airborne. It seems like there's a crazy now bid for vacation homes. Do you think that lasts, or people eventually want to go to other places and not just to the same place over and over again?
So I can argue it both ways, but I think there's a little bit of a bifurcation. If you're one of the things we've seen in certain markets, like in Phoenix and in South Florida, or on the east coast of Florida, is the demand for second homes for people in cold climates, particularly high tax cold climates. That demand has increased pretty dramatically for second homes in lower tax, warmer climates for winter and potential tax residency.
Yeah, it's a second home that could become the first home.
That second home that can become a first home for tax purposes, but not necessarily for actual purposes, is one of the things we're seeing. And that's state by state based on whatever it is that you become a resident for in that state. For what I'll call vacation home rentals, where you're going to go away for a week a year, 2 weeks a year, and each time you're going to go rent someone else's house, that's something that we think will continue to be pretty stable, at least for another year, year and a half post-pandemic, as people view single-family houses that they can rent as safer than being in a hotel with 200 other people that you don't know. Whether as the side effects of the pandemic wear off, say a year and a half from now, 2 years from now, whether you'll see that to level off or decelerate, we probably expect it a little bit, but we don't expect it to go to where it was in April or May, where nobody was willing to ever rent Airbnb. And on the hotel side, we back in the early 2000s, we bought up quite a few hotels and created a hotel management company that we then spun out in 2006. And we've looked at hotels again, and we think there's going to be, at least for a few years, a divergence between what I'll call more resort vacation hotels, which we think people will come back to pretty quickly post, to the extent the vaccine is successful, but less so for kind of the urban, more business-oriented hotels. We think those will come back a little slower.
Yeah, I mean, we were looking at that, and even during the darkest days of April of last year, the Ritz-Carlton in Santa Barbara, which is about an hour outside of LA, I think it was just under 50% occupied. So it was 45 to 50% occupied there. It's pretty good given how bad things were. But business travel is definitely the big unknown.
The big unknown. I think it'll be slower to come back than vacation travel. And it would be hard to imagine it would get back, given the work from home and the Zoom and things like that. It would be hard to imagine it'll get back to 100% of where it was. But I think over 2 or 3 years, it will come back. I don't think, despite so many people saying they really enjoy not business traveling, I think most people actually would like to do some business travel. Versus zero business travel.
Depends where, but yeah, let's go back to housing before we go to commercial real estate. There's 2 themes out there I want to talk about. One is the flight from urban to suburbs. If you looked at the data, let's call it 6 months after the pandemic, you definitely saw a theme of suburban areas doing better than the urban areas as people left places like San Francisco and Manhattan. It's actually hard to get data because there really isn't like suburb data. It's like urban and or rural, and a lot of suburbs, if they're a certain square mile from the city center, they could be considered urban, but really they're the suburbs. We have a lot of that in Los Angeles.
Right, and even the data comps are simplified by kind of the big data providers like the RD Matrix and things like that. And as a result, things that show up as comps aren't really comps. And it's even more so for suburban than it is for urban.
But it seems like the recent data has shown that the urban areas are now actually going up in price more so on a month-over-month basis than the suburb areas. People are starting to go back. I mean, if you're a younger person that you couldn't afford the city before, now rents are way down, or prices are down, and mortgage rates, I know they're going up with rates going higher, but they're still low on a historical basis. And people are kind of coming back to the city in hopes of normalization and the vaccine rolling out. What do you think about that kind of theme of going back to the cities?
We're definitely seeing that. I mean, if you look at the people who were urban who then became suburban, there's 2 what I'll call subgroups. One subgroup is they were urban and became suburban, not because they went and rented a suburban apartment. They were 23 and they went and lived with their parents because none of their friends were still in the city. And as a result, those people, you should expect the vast majority of those will become re-urbanized versus living in the suburbs, of leaving their parents' house and living in a suburban apartment or staying in their parents' house. Those people clearly will re-urbanize, and we're starting to see that already. The other group is what I'll call the next age group, call it late 20s to mid 30s, young family, where they suburbanized and they either went to a suburban apartment that was roomier with walking space, or they bought a house. I think the phenomena of de-urbanizing to go buy a house will slow down a little bit as people get more and more comfortable that the pandemic gets under control and a vaccine rollout actually works and calms down. But we're definitely seeing people coming back into the city. The average person in their 20s doesn't want to drive an hour and 15 minutes in from the suburb into the office. For the younger people, they actually want to be in the office more than the more experienced people. And most businesses really want younger people in the office so they can get the mentorship. We're definitely seeing it coming back. It's not coming back at the same pace that it left, but that I think is a matter of time, and we'll get back to pretty close, if not more so over time.
Sure.
But it's not a one-day event.
Yeah, and you brought something up. I think it's important, but we'll talk about it later. Is the fact that there even as much as you like working from home, there is a need to come back to the office. It's for the next generation, the younger kids. But we'll talk about that when we get to office real estate. The second thing we've talked about is the move out of the high tax states into the low tax states. Mm-hmm. We're seeing a lot of that in California. And, it's one of the things we look at when we buy mortgage assets is we make an assumption when the mortgage rate's really low. Hey, this person, they're never going to move. They've locked in this, 2.8% 30-year fixed rate mortgage. We don't think they'll ever move. But what you're seeing is that movement happening. But it's interesting, and you guys have done some studies on what that demographic is. Maybe you want to tell that story to the audience.
We tend to be data geeks, and we literally lot by lot by lot, and street by street by street, and block by block by block. And one of the things we found is two different features. One is since COVID, and one is pre-COVID, but has continued through COVID. And we've done it, the analysis. Location by location by location, and the ratios and the numbers are a little bit different city by city and market by market and submarket by submarket. But for example, in California, one of the things we found is we've had a lot of very low interest rate loans that have been modified, maybe 5 or 10 years ago to 2.5% interest with 40-year amortization, which you would never expect that loan to prepay because no one could ever replace that low 40-year amortization 2% payment. But what we found is a significant number of those loans, for example, in Southern California, that had at least 130 or 140,000 of equity, where both borrowers, husband and wife, were over the age of 59, and they had no children living within 120 miles. We found them selling their house, taking the cash, and 18% of those people moved to Nevada within 60 days. And so we started looking at this city by city by city and market by market by market. So if you look at that, say, Southern California, but if you look at that in Indianapolis, it's husband and wife are 64, not 59 or over. And the minimum dollars of equity is in the 70s, not 130 or 140. And then they tend to move to a lower tax or warmer state, Phoenix or something like, or the west coast of Florida. And we've seen that over and over, but the only place we haven't seen that really kick in is in the five boroughs of New York. We've seen it on Long Island. We've seen it in parts of New Jersey. We've not seen it in the actual boroughs of New York. We've seen tax moves from New York, but we haven't necessarily seen selling your condo in Manhattan tax moves moving out of New York.
Interesting.
Yeah.
Yeah. What one of the things we talk about though is some of these low tax states, can they stay low tax given the influx of the population? Just look what happened with Texas and their infrastructure. Even Arizona just raised state taxes on the
That's right.
I think on the high end, but there seems to be
above 400,000 of income, right?
Yeah,
and that's going through a litigation process as whether it's constitutional or not. Eventually, the states with large move-ins are going to need more infrastructure.
Yeah,
and something's going to have to pay for that infrastructure.
That's right. Well, let's move on to commercial, which I think is one of the hardest hit parts of the economy, given the change in, again, consumer and business behavior. But it's, again, bifurcated. Like you said, with residential, certain geographies are doing better than others. Industrial seems to be like a rock. I mean, with everyone sitting at home, buying stuff off the internet, you need these big industrial logistical centers. And multifamily, people still need to live somewhere. And it seems like largely multifamily is doing well. But there's a story out there about the really high end suffering and the really low end suffering, because that's where the job losses are. I know you guys invest across a spectrum of multifamily type investments and even kind of lower end class C in urban areas. Are you seeing weakness, or are things still pretty good?
So we're seeing the most negative effect is in class C and high end class A. And for what we invest in and what we see, B+, B minus has held in pretty well with a couple of exceptions. For example, Houston's been a worse market than some others because it's had the double whammy of a pandemic and an energy industry shock. So the Houston market's been worse than many others from a rent, a multifamily. San Francisco, rents are down dramatically. New York rents are down dramatically, but that's really more of a high end market down dramatically versus or a class A minus market down dramatically as opposed to the class B. Class B, we found in many places, rents are actually higher. Our experiences in Dallas, class B has actually gotten a little bit better. In Atlanta, class B is better. And a few other markets, we've seen class B better, and class B kind of across the board is held in seemingly a bit better than the high end. Class C has probably been pretty materially affected. Also, you tend to have more service industry employees, which have been significantly more affected by the pandemic. So we've seen kind of class C and class A being the most affected, and I'll call it B minus to B plus or B minus to A minus have held pretty steady. And in fact, we're starting to see rent increases in a lot of locations. We're certainly seeing it, for example, in Charlotte, B plus, A minus, we're seeing rent increases.
Well, one of the things that definitely has helped the real estate market is the fact that the lending markets came back so quickly. Like you said, the global financial crisis, banks were going under. And so getting loans was really difficult. Now the securitization markets came back quickly. Fannie and Freddie are big in agency multifamily lending, which is to mostly class B as we talk about it. One of the things that you've mentioned is that the banks, although they're in a good spot financially as far as not that much leverage and not that much losses, they don't really want to lend though because they don't want to end up with real estate, right?
Yeah, we found that the banks are a bit skittish about commercial, and with multifamily less skittish, but very skittish on retail, very skittish on office, a little less skittish on industrial, and most of their industrial skittishness comes from cap rates are so low in industrial that they're concerned of overvaluation as opposed to anything else. Where in retail and office, they're scared of the unknown, and they're very, very skittish on that front. We definitely seen them less interested in large Class A or even apartments, but even more so in retail and office. They're afraid of owning real estate.
Yeah, I guess what that does create though is it creates an opportunity for kind of private lenders to come in to make those loans and take the place of what the banks have historically done. So it's a kind of a good time to be a
absolutely
lender.
Right.
Yeah,
that's exactly right. It's a good time to be a lender that doesn't have capital requirements.
yeah. So it seems like, what would you say the worst part of the commercial market is? Is it retail or is it business hospitality?
Well, in retail, I'll break it out between what I'll call mall and mall-like, big box at malls, movie theaters at malls or malls themselves, versus what I'll call strip centers, neighborhood strip centers. We're a lot more bullish on the neighborhood strip centers, what we'll call Amazon proof, than we are about big box retailers in malls. We used to have a flow arrangement that we stopped in 2009 with a couple of large big box retailers that when they closed stores, we bought the real estate from them. And, the Amazon effect on big box retail, that's something that people should have known 10 years ago was going to happen. It just happened faster because of the pandemic than it ordinarily would have had, but it was going to happen anyway. It was just a question of whether it was going to happen in 2000 and where we'd be now was going to be in 2030 versus in 2021. And we stopped that because you could smell the kind of the Amazon conquering kind of big box retail over some period of time. And malls, have been seeing this already for a few years, and they've been turning things to become more experiential. They've been putting food halls in malls. They've been putting gaming in malls. They've been putting in, laser tag in malls and things like that, because they're just trying to get people there to make it more experiential. So they are already aware of the Amazon issues, Amazon-like issues for a long time. This just caught them so quickly that there's not much they can do about it. The neighborhood strip centers, lockdowns have hurt those more than desire of people to go there has hurt them. So then Amazon has hurt them. So, the neighborhood food shop and the neighborhood nail salon or the barber shops, those will come back, and those neighborhood strip centers will be okay. Amazon is not coming to your house to cut your hair. Right.
Yeah.
So we're still pretty bullish on those over time, neighborhood strip centers. And we're pretty bullish on kind of the ground floor retail with apartments above urban still. Malls, they're going to have to come up with some other way to get people to come even post-pandemic, because I think for the most part, people like, other than something they need to try on and get tailored, people like sitting in their living room and shopping.
Yeah, I think so. But there is something to be said about the lifestyle centers. We see some successful ones in Los Angeles, like the Grove. People want to go out and stroll. And I think what you're finding,
right. They have to be That's right. Have to be experiential.
Yeah, and I think what's happening is the companies are realizing the stores can be much smaller, and the store is more of just a display, to show off the brand, like a smaller Nike store, for example. I mean, Nike made a big push and Nike is up near you in Oregon, right? The headquarters, but I think they were shocked at how much online sales they got. I mean, they had some killer numbers last year. And people are just getting more and more comfortable with buying online, and these retail centers are going to have to evolve. And one of the things that people hypothesize can happen is some of the big boxes will end up being logistical centers for Amazon or one of Amazon's competitors.
Yeah, because for all that distribution, the last mile is really harder than the first 1,000 miles, and there's a lot of belief that closed big box retailers could become last mile distribution centers. They'll have to add dock high doors, and there'll have to be a lot of technological advancement in those facilities themselves. But it's a lot cheaper to do that than ground up. And they'll also have to get um, mall customers to be comfortable with parts of the mall are going to be filled with 18, or parts of the outside of the mall are going to be filled with 18-wheel trucks and dropping things off, and vans leaving all the time, as opposed to just parking for the customer.
And maybe drones coming in and out. We'll see.
Yeah, that'll be interesting. Yeah, that's not a little Blade Runner-ish, but
yeah, I mean, they're just so loud. I mean, they're
right.
not really, they don't create a peaceful environment. I don't want drones coming up and down in my neighborhood, dropping off boxes. But hopefully,
although
go ahead.
We've had some developers for office buildings, for example, tell us that they think, sort of like the Blade Runner movies, people will start commuting eventually via drone, and they're going to want to come to their window of their 30th floor office, attach the drone to the window, and walk into their office. So I think that's a little farther away than they want to believe, but that people are thinking about that already.
Well, we talked a little bit about hospitality. I guess of course the resort style stuff's doing well, and the business travel related hotels are lagging a bit. We have this argument, I don't want to call it argument. We kind of had a discussion amongst ourselves on our Teams calls, since we're not in person. But we were saying, okay, if our competitors start traveling for work, we're going to say, well, we got to do it too, right? And I think that's a valid thing that can pressure people that don't necessarily want to travel to start having to travel again, because it becomes just part of normal business activity. The argument I brought up on why it may take longer is you may want to go see the client. The client may not want to come see you, because they can have a conversation like this on Zoom and probably get more done in their day and not have so many people coming in through their offices, right? I feel like the Zoom has become, Zoom and Teams or whatever, WebEx is becoming a more acceptable way to communicate.
I think that's right. And a lot depends on how many people actually work full-time back in their office again. Because the one thing you're not going to do is you're not going to go on the road and go meet people at their houses.
Yeah.
Right. So if the work from home continues to be a phenomena that doesn't slow down, business travel won't come back nearly as fast as people think, because there'll be no one to go see. There'll be no offices to go meet the 4 people that you want to talk to. Otherwise, I think if everybody was already back in the office, I think people would be traveling already to go see people in the office, just because people have been cooped up so much. They just want to go have some human interaction and do some traveling. That being said, it remains to be seen. There's a lot of arguments that you can make as to whether people will be back in the office or not in the office. And I think a lot of people would like to be back in the office, but we don't think it's going to be back to where it was a year and a half ago in terms of where everybody is in the office. We think there'll be some piece that close to permanently will be work from home, but we think that's actually a material minority rather than a majority of most people. There may be a large amount of hybrid where you, like one of the things we've seen in Manhattan is we've seen a significant increase in rentals of studio apartments. And it's really pie to tear. People who don't want to take the train in every day, now what they're doing is they're driving in on Tuesday morning early, and they stay in their studio apartment Tuesday night and Wednesday night, and then Thursday they drive back home Thursday night. Yeah. So they spend Monday and Friday at work from home and live in a studio apartment Tuesday night, Wednesday night in the city. And we've seen more of that, for example, in the last, call it 6 to 8 months.
Yeah, I think the surveys show that the majority of people, let's say 2 out of 3, they want to come into the office, and on average, it's something like 2 to 3 days a week. Like that's the sweet spot. There's definitely a number of people, I would say like 15%, that they never want to go back to the office. And there's on the on the far extreme, there's 15% of the people, maybe 15 to 20. It's probably a younger cohort that want to go to the office every day, right? But most people are in that kind of go back to the office 2 to 3 days a week. And I mean, that's the camp I'm in, just given my commute.
Mhm.
I'm one of those, hour plus commutes out of downtown LA. But I think the interesting thing about what happened with the pandemic is it forced the work from home. People have been trying to push telecommunication since as far back as probably the 60s or 70s, I would guess.
Right.
And the big problem always ended up being technology, right? You were
Yep.
back then it was telephones and typewriters, but even 10
Hey,
years ago, I mean, when we
there's
started
more.
DoubleLine 10 years ago, I don't think we didn't have Teams, we didn't have the high speed internet to have everybody on a video conference call together. So the timing was almost right for the technology to be there to allow it to happen and be
Yeah.
successful, right?
Oh, there's more computing power on my iPhone than there was on the DeckWriter mainframe I worked on during my dissertation in the 80s. So it's the technology's made a huge difference and given people the ability to have multiple locations, multiple place functionality, and darn close to work from home technological capability as the being in the office and working in the office. I think the big difference in work from home for a lot of people is, do you learn as much working from home as you do in the office? For a software developer that's sitting in a room with 100 other developers at a desk wearing headphones and doesn't hear anybody saying anything at any time during the day, working from home is entirely different than for someone who just got out of college and is a first year in an investment banking program in New York, and they need to learn a sense of smell, which they can't develop at home, so that 3 years later, they can manage another group of first-year analysts, and that 6 years later, they can manage a group of third years who are managing a group of first-year analysts. Where if they don't develop that sense of smell, when a firm wakes up 3 years from now, 5 years from now, that next layer doesn't exist.
Yeah.
And so mentorship happens in the office. It's much harder to have mentorship with people working from home, especially the younger people. That being said, one thing, especially for the experienced people, this pandemic has shown is that it's really, really, really important for your people to have talent, not just be in the office. That you know what I mean? That talent is really the most driving force, and being in the office is a multiplier effect of that, as opposed to causing talent.
Yeah, I guess that leads us to talking about commercial real estate. I feel like that's the one where the jury's still out. There's a variety of opinions on people that are bullish or bearish. If you talk to somebody that's already long, right, the underwater trader that's already long the real estate, they'll tell you the bull case. And the bull case, a year back when I was talking to people, was that if you go back 20 some odd years, the average square foot per employee was probably about 100 square feet, because everyone sat in an office, and the office maybe wasn't 100 square feet, but if you threw in the communal space, the kitchen, the hallways, the elevator bank, and so on and so forth, 100 square feet. And that number's come down a lot, pre-pandemic, because more and more companies and businesses were adopting kind of the Wall Street trading desk model, which is
especially creative space, very much like that. You're right. The more the Wall Street trading. Yep.
So the argument is, well, nobody wants to sit on that trading desk together anymore. People want more space, so you're gonna have to go back to 100 square feet per employee, and everyone's gonna want to sit in offices again, and so people might need more office space than they did before, which could be the case, could be not. I think there's somewhere in the middle where that probably shakes out, and then secondly, you've got the fact that businesses, we're heading a year since the pandemic, they're kind of saying, well, some portion of our workforce is probably going to work from home some days of the week. And, if we had 4 floors like we do here at DoubleLine, maybe I don't need 4, maybe we need 3, maybe we need 2. So there's a lot of kind of uncertainty out there. What's your take on what do you think is going to happen? I think it's probably regional too, right?
To some extent regional, but I think our bias is that we're not going back to everybody being in an office. I think people do believe that collaborative work environments are more successful and productive for companies than everybody being isolated. We have an old saying that offices brew secrets as opposed to collaboration, and offices brew HR drama versus collaboration. And so we don't see that model coming back. And we do see more people working from home, and we do see a hybrid model coming, which is going to need less workspace. The biggest question is, in a hybrid model, do you have everybody still in a creative environment, but you predetermine when people can come in and when they can't, so that you don't have people sitting 3 feet from each other, you have people sitting a little farther from each other, so that you have a consistent 50 or 60% of the people all the time, just different 50 or 60%, on different days. So we think the hybrid model is more likely. We think there's going to be some subset that always is going to work from home. We think there's some subset that always is going to be in the office, and we think a big group is going to be a hybrid model. But office, and we don't think it's going back to everybody being, 10 feet apart and having separate desks all over the place. We think the collaborative model is still going to be there. The other question we have is, for example, big banks. Will the big banks, for example, in New York, will they create a Long Island facility where the people in Long Island can work out of? Will they create a Connecticut facility? Will they create a New Jersey facility so that the people in Manhattan can come into Manhattan, the people in Brooklyn can come into Manhattan, but the people in New Jersey can work out of a suburban office building in New Jersey and cut commute times? And will that be kind of a hybrid model?
Some of them are already doing it. I think, a lot of the big banks already started that, right?
That's exactly right. And the question is, one, will they keep that going? I mean, for them, that suburban space is so much cheaper than Manhattan office space.
Yeah.
It gives employees, somewhere between 30 minutes and 90 minutes each way back in their life of commute time into Manhattan from the suburbs, depending on where you live in the suburbs. And so the employees really like it. So the question is will the big banks stick to that? Will they make it more important to do it that way? And will other people follow them? So, but I think we would agree that the real estate footprint that most companies will need is going to get smaller and the only offset to that is dramatic expansion of the company as opposed to dramatic expansion of the office space without dramatic expansion of the company. We're probably a little more bullish on the suburban space than we are in, the 40-story high rise in Midtown Manhattan as leases expire.
Yeah, I mean, I have a good friend who does commercial leasing in Los Angeles, and one of the things that we talk about a lot is how the pandemic has just changed people's behavior and their demands and what they want. And a lot of companies wanted to be in those big towers. Clients come and it looks fancy, so on and so forth. But he's saying that there is still demand for office space, but people want a freestanding building. It's just their own building for their company. And they want that with, something we can get away with here in Los Angeles with the great weather. They want it with outdoor space. And so there's actually a big increase in demand for that type of property. And it's hard to find it. And one of the places you can find it is out in El Segundo, and it's old industrial space. So that's another thing that's increasing the demand for formerly industrial real estate is people wanting to use that and change it into somewhat of like a creative office space. So the pandemic has continued to change the way that we look at where we want to be for work, right? Maybe it's home, maybe it's the office, but the office, nobody would have ever thought, 30, 40 years ago to set up an office out of industrial real estate. And now
that's exactly right.
It's in high demand, right?
The other thing is that one of the things people like about working from home, aside from not commuting and getting, an hour back each way of their life, 2 hours a day of their life, they like not wearing dress clothes. They like sitting at their desk wearing a golf shirt and sweatpants or wearing something basic. And that is going to be an interesting phenomena when people get back to the office, is that what effect is it going to have on retail in terms of the change of what people will be wearing as a result of having worked from home so much?
You mean the continuous discount offers from Brooks Brothers aren't appealing to you? Seems to get cheaper every day.
That's exactly right. That's exactly right. It's that's a pandemic phenomenon that you don't hear much about, but it's certainly going to change what retailers sell, not just what retailers exist.
Yeah, the athleisure attire. I mean, I keep a golf shirt in my office to wear whenever I jump on calls, but otherwise, I'm sitting there in a t-shirt, or in the summertime it's hot in a tank top, and it's going to be interesting to see people if they have to get dressed up formal. I think there's some demand for that. People enjoy maybe once in a while feeling a little bit more normal, putting on some clothes and going outside, and that's kind of that pent up demand story that's out there. What do you think about that pent up demand? I feel like it's real. I feel like we're definitely going to see a near term boost in some consumer spending as the economies open up and people want to go back to restaurants. People want to go out and travel. I definitely think there's going to be a near term boost. How do you feel about that?
I think you're right. I think that there will be a near-term boost. Clearly, people have had more savings in the last year than they would normally have. There's going to be definitely a cooped-up demand for vacation travel, where people are going to immediately take a week someplace or take 2 1-week trips because they haven't been able to do much. You're going to see some immediate business travel just for people to feel like they're back on track. You're going to see people rush out to restaurants, and there's less restaurants. So the restaurants that still exist will be beneficiaries of still existing when that happens, versus kind of the large restaurant supply that predated it. The one that's going to be interesting is what I'll call business dinners. There's a lot of restaurants where for example, they make their margin on selling wine at business dinners. That's really kind of their margin. And business dinners is really going to be dependent upon whether people are back in the office or not, because the person who lives in the suburbs isn't going to drive an hour and a half into town to go have dinner and then drive an hour and a half back, unless they're working out of the office and they've been there all day. So the business dinner is the one that's a little harder to figure out what's going to happen. But I think the leisure dinner, there's clearly going to be both leisure dinner and leisure vacations. There's going to be an immediate kick back to the pace of that, post-pandemic.
Cool. I guess that's good news for the resorts. Let's,
Yeah, it's good news for resorts, and it's interesting. We spent a lot of time tracking hotels because of our previous investments in hotels back in 15 years ago, and we've definitely seen the resorts do well. We've seen what I'll call the interstate highways hotels that cater to the logistics drivers. Those have been pretty much 60-70% full. It's really the in-town, more business-oriented traveler hotels that have suffered the worst, and who probably have the most need to determine whether there's some other use of their facilities or not. There's a lot of talk about turning hotels into apartment buildings, but it's really expensive. Most hotel rooms don't have 2 baths. Most hotel rooms don't have kitchens. Most hotel rooms don't have multiple rooms. So the redesign of the hotel and the amount of construction, in order to turn them into apartments, they're either going to have to be Class C or Class A plus, because you either have to do very little work and just put in kind of cheap efficiency kitchens, or you have to do an enormous amount of work and combine rooms and replumb and rewire all the hotels to turn them into A plus. And it's going to be very hard to do in the middle.
Yeah, I've seen some people talking about the turning them into affordable housing for homeless and things like that. So that would be what you're talking about, turning them into C plus type units. So
That's exactly right.
Seems like you think there's a future for some of these hard hit parts of the real estate. Is there a way outside of actually buying the real estate that you think is interesting for the average investor to kind of play it? Is it through real estate REITs? They got pretty beat up last year. They've recovered some. Like, how do you think is the best way to get kind of exposure to that kind of investment for the average person?
Sure. I think REITs are a good place to do it. I think that if you believe there's going to be a significant rebound in commercial real estate, then across the board, I don't think we believe it's across the board. I think it's much more sector by sector by sector in terms of kind of degree of recovery. There's some smaller, what I'll call commercial bridge lenders and people like that who will be liquidity providers for people doing renovations and upgrading properties and things like that. So that's one potential way of playing it from a more, what I'll call fixed income approach. And I think REITs, while I think apartment REITs have kind of been hit a lot harder than what their apartments are actually worth if they were to, sell. Depreciation on REIT balance sheets in many cases understates what the actual kind of sum of the parts really is in terms of what I'll call book balance sheet for a lot of equity REITs. But it's going to be different sector by sector. I think there's for people who can be liquidity providers to hotels, if you pick your hotels right, that could be a pretty good business also, but there's really no kind of liquid way to do that. It's really more, there's no kind of average investor, mom and pop who could do that. That's much more of an institutional, less liquid way.
Yeah, maybe if there's some REIT or one of these BDCs that's doing that kind of like lending or opportunistic lending, maybe they can find a way to do that. Well, we're running out of time here, but I've got some some questions for the audience. One of them you already answered though, which was where you grew up, which is Buffalo, which is also
Buffalo, New York.
Our CEO and CIO Jeffrey Gunlock from Buffalo too. He says the best weather during the summer in America. How do you feel about that?
You know what, Buffalo, Buffalo gets a lot of grief for its weather. I grew up, there were a lot of snowstorms. I missed one day of school in 13 years, kindergarten through 12th grade. And I think my dad was probably never late for work growing up in Buffalo. And during the summers, it's 80 and sunny with not much humidity. The only issue is I wish the summer was like 1 month longer.
It's a little too short. Yeah, I hear you. What do you have a favorite sport, and or did you play a sport growing up?
Yeah, I grew up as a young kid. I grew up playing hockey, and then I migrated into soccer, basketball, and baseball. And in college, I played baseball at Chicago, and I was on the basketball team, but I wouldn't say I played basketball.
All right. What's the one thing that you miss about not being in the office?
There's probably two things that I have to say about that. One is I miss the personality of the people and the ability to, as the CEO, have interaction with everybody and hear what's going on with their lives and think about company culture and direct how kind of things happen inside the office and the atmosphere. And then number two, I miss on more transactional type things, just being able to turn around and ask somebody a question versus having to get out a phone call and get multiple people and then get the lawyers, and everything takes 6 drafts instead of 4 drafts because of documents. So those are kind of the two things that I miss the most.
I was talking to one of my colleagues, and we were discussing how everything feels like a transaction now, right? You're only
right.
you're only trying to communicate with somebody because either they ask something of you or you need to ask something of them, and there's
Right.
less of just the casual discussion, which leads to more creative business to be had.
That's right.
And the other thing that I find now that we're a year in is that when this all first started, there was obviously a lot of volatility in the marketplace, a lot going on, and more activity. It seemed like people were just interacting more. And as things have kind of calmed down in the marketplace, I just see a little bit like more distancing of the groups. There's certain people you have to interact with, somebody that's in your group, and other departments, that interdepartment interaction with those people, because there's no kitchen to run into people during the lunchtime. I just feel people are getting more distance through time.
Yeah, it takes the corporate culture and turns it a little more into vanilla rather than vanilla chocolate and strawberry.
Yeah.
And it just takes the interest that people have in each other and makes it scarcer, as opposed to, you feel in the office, people feel more like they are a team, and they work together and they cause things to happen together. And when everybody's at home, a little more isolated, it becomes a little more individualistic, and it's a little hard for companies to have their culture be through and through in people's bloodstreams when they're all at home.
Yep. The 7-year Treasury auction, a disaster today. What's going on? We talked about it before we started recording. Seems like the fervor of negativity towards bonds has rapidly increased this week.
Yeah, I think you're obviously much more involved in kind of the daily fixed income markets than we are. One of the things is that we've seen is that the demand for people to be invested has caused them to buy things almost yield agnostic, and a lot of money went in to buy things just to buy things, so that they could make, instead of making 0.02 in their bank account, they could make 0.33 in a treasury somewhere. And when people decide that, oh, there's some risk to that, or rates might widen, all of a sudden there's a switch that gets flipped, and the supply demand equality doesn't exist for that period of time, and you see a little more volatility. I would guess that from our perspective, we'd probably see it, as we discussed a little earlier, it to come back and rally a little bit. But we think that our bias is that with all the liquidity that's in the system and all the savings that people are going to start spending, that we're a little more of inflation sensitive than I think the average investor is right now.
Yeah, and I feel like inflation, at least in the near term, you're going to start seeing it. There was an article today in Bloomberg about companies, because commodity costs are up, they think they can increase the price of their product and still get the same demand. So they're at least going to try, and you can see prices slowly going higher. Yeah,
we would agree with that.
All right, last questions. I haven't even looked at my Bloomberg. So stocks are down a lot today. Is this the beginning of a correction? Are you going to call the top of the market?
As my father would say, if I could predict the stock market, why would I tell anybody?
Yeah.
Right. Some of the prices that we've seen seem to have more to do with people having savings and money flowing in, as opposed to anybody caring about valuation. I mean, we've clearly seen, like in our own business, no one seems to care about value. They seem to care about momentum. And so you've seen, in a lot of the investment sectors, value stocks, are cheap, some of the parts being worth more than the whole stocks, being ignored because there's just no excitement to them. There's, I don't want to have to wait 2 years to be smart, right? I want to be smart by tomorrow. And we've seen more and more and more of that. And, you know, we have a large group of, aside from kind of our institutional investors, we also have a group of about 20 kind of high net worth family offices. And we've seen it with some of the family offices feeling much more compelled to get involved in things they wouldn't normally get involved in because it's like a fear of missing out. And unfortunately, that works both ways.
Yeah, it seems like everyone wants to buy the .com company now before it comes to market, right? That's why we've got all these SPACs.
That's right.
There's a book I think I talked about this on my last episode, but there's a book I read. It's called The Great Crash. It was written about, you know, the stock market crash in the before the Great Depression, and there were these investment companies where the purpose of the investment company was to the company was raised, the money was raised in order to buy a company that hadn't been identified yet, which is basically exactly what a
that's basically what a SPAC is, right?
And the stuff would trade up in value before anything was bought. This is back in the late 20s, because people thought that whoever was running that investment company was so smart that they're going to find, you know, the next Facebook or the next Apple, and that exact same thing is happening again with the SPACs trading up before anything's bought. So it just surely seems like the speculative fervor of what's the next big thing that's going to go up really fast. That's what everyone wants to talk about, right?
Yeah, and I think to some extent, low yields have made it even more attractive to people, or at least the aura of it more attractive, because when they look at the alternatives, I'm going to go buy a U.S. Treasury fund and make 35 basis points, or I'm going to go invest in munis and make sub 1%. It's in many cases sub 0.25 or 0.5%. And as a result, people, I think, have been led to buy things. And we see it, for example, in what I'll call mom and pop real estate. So that if you bought an apartment building in Los Angeles in 1985, okay, you've done 3 or 4 cash out refis where your basis is now negative 2.5 times what you paid for it in 1985. Okay. Now you're afraid that your 1031 exchange might get taken away in a new tax law. So you want to sell it and roll into another property in a 1031 exchange as fast as possible. And you couldn't care less what you make on it because of the tax savings. So as a result, we've seen some real estate trade at 1.2% cap rates with 1031 buyers who couldn't care less if they even make money on the new purchase. They just don't want to pay tax for the next 10 or 20 years. And it changed. So they're investing for a different reason. And I think we've seen it in retirees. If you're a retiree living on a fixed income and what you were making a number of years ago was 5 or 6% on your money, and now you're making 1% on your money or 2% on your money, it's a much harder life. So you got to figure out how to make 6%, right? Even if it means overpaying for things in order to make the 6%. And we've seen that in the high yield credit market, the quote unquote high yield, right?
Yeah. Well, it yields more than it did like a couple of days ago with the rate rise. Well, Larry, thanks so much for your time. Thanks for coming on. Always really interesting to hear your take on real estate. And I hope to see you in person one day soon and at one of these restaurants that hopefully will be opened up.
I agree with that. I agree with that.
Take care.
Thanks very much for all the time. I appreciate being invited, and have a good rest of the week.
Okay, you too. Take care.